All right, everyone. Well, welcome in again. We're back in April of 2025 talking about markets and economy. And as we record this, there's maybe a lot of pending news about further trade policy, but we know none of it at this point. So if you were expecting a rapid response to any trade policy announcements, we don't have them yet. So we will do our best to talk about the overall conditions that we're all sitting in right now. Um, so as we always do, introducing ourselves in case this is your first time catching the webinar. I'm Jarrod Musick. I'm the CEO here at Destiny Capital Entrepreneur Aligned. And I also sit on our investment committee with Tim Doyle. So really a thought partner on the investment side and then working with a lot of our client teams and our client families on how do we translate investment guidance and decisions into individual decisions at the family and household level. Tim?
Yep. Thanks, Jarrod. Yeah, my name is Tim Doyle. I am the Chief Investment Officer here at Destiny Capital. As Jarrod said, I manage our investment committee. That includes investment manager research, capital market research, fund due diligence, portfolio construction, trading, rebalancing, technology, and anything that goes under the investment management umbrella, including client communication, webinars, and blogs, like the video recording today. So I think this is a timely one. There's a lot going on, and hopefully we can have a really good discussion about it today.
Before we jump in, we always have to go through our disclosures. So everything that we have created for you here is as accurate and authentic as we can possibly make it. There's the potential that we made errors. We're also going to be discussing markets. I don't think any individual securities or positions today, but if we ever do discuss any of those, please do not make any investment decisions based on the context of the conversation today. If you already work with us, reach out to your lead advisor, your client service team. If you don't work with us, CPA, tax advisor, attorney, somebody who can help you make a good decision is somebody that you want to talk with about anything that we're talking about today. And then Destiny Capital, we're a registered investment advisor and we're registered with Securities and Exchange. So there we go. Let's dive into what's going on in the world today. And I think probably something that we've hinted at in the last couple of these. But just the change in consumer mindset and sort of how that ties in with a degree of uncertainty that we're experiencing right now in a number of areas. So, Tim, do you want to kind of walk us through the mindset of the consumer and why that's so important from an investment standpoint?
Yeah. I mean, Jarrod, we were talking about this just before we hopped on this webinar, the level of uncertainty that we're all feeling today. I mean, I'm refreshing my web browser right now, every 5 minutes, waiting to see news on tariff and trade, the global economy, how that's going to be impacted by the Trump administration's policies on tariffs and trade. And that's just really bleeding into consumers as well. They're feeling that. So we're consumers ourselves. We're feeling that uncertainty about what the future might bring, where the economy might be headed, where inflation might be headed. And that's really important to track because as goes the consumer, so goes the U.S. economy, really. And we'll get into that a little bit more later on this slide. But first, I wanted to touch on inflation expectations because we've actually seen a considerable shift upward in consumer inflation expectations. You could see that in the chart to the top right. So if you look at this chart and then scan all the way to the right side of this chart, you see the two lines illustrated there, hockey stick upward, and that's alarming. These two lines show, the green line essentially shows the 12-month inflation expectation. So 1 year from now, what is inflation going to look like? And consumers expect inflation to be at 5%. That's far above the Fed's 2% target. And then we look at the longer term targets. So where do consumers expect inflation to be in 5 to 10 years? That's also hockey stick. And this is very rare to see consumer expectations rise from roughly, let's call it 3% to just about 4%. So percent increase in just a few short months is eye-opening. When the Fed is talking about inflation expectations and talking about inflation itself being well anchored in the long run, they are talking about their own long-term projections, the internal projections and the numbers that they run. They also are talking about consumer expectations because it's almost a sense of self-fulfilling prophecy, right? So if consumers expect inflation to be higher, prices tend to move a little bit higher. And that's something that historically the Fed has been really concerned about. That's why they set the 2% target in the first place, because if they felt if they set a low 2% target, then inflation in the minds of consumers would get anchored at that 2% level, and that would keep it more consistent over time. Just almost a behavioral finance kind of thing going on there. So that's been really important and interesting to track. We'll see if this is just a blip. We'll see if all of this is just a blip, right? 1 month or 2 months does not a trend make, but this is something we'll be tracking over time. And then we look at consumer sentiment. So the University of Michigan conducts a survey where a random survey of U.S. households where they ask them about their personal finances, business conditions. It's just a survey of like, hey, how are things going with your personal finances? What do you think about the economy? And you could see this on the chart to the bottom right, where we see if you scan all the way to the right of this chart and follow that line, you can see a steep drop in March of 2025. So around year end in December, consumer sentiment was around 74, still below historical averages, about 84, but still it climbed back from the doldrums of 2022. But then it's since fallen off a cliff, and it's down at 57. So from 74 to 57 in just a few short months, and that's concerning as well. So and if you look at a historical perspective, consumer sentiment bottomed out. The absolute bottom of consumer sentiment was during 2022 when inflation spiked to over 9%. And right now we're actually approaching that level, and even approaching levels that we saw back in the 2008 Great Financial Crisis. So sentiment is almost on par with the Great Financial Crisis, which is definitely eye-opening, right? And that happened quickly and suddenly. And I think that just speaks to the uncertainty that everybody's feeling. You know, an optimistic consumer can lead to accelerated growth that can be additive to GDP growth in the United States. A pessimistic consumer can tighten their belts, right? Maybe if they're worried about their job, or they're worried about their financial assets, their investments, maybe they're not spending as freely. And that can cause a broad slowdown in domestic growth and even potentially global growth. And we've covered this before. I touched on this briefly at the beginning of this slide, but 69% of U.S. gross domestic product is consumption. So consumers like you and I, Jarrod, buying goods and services. So as long as we're buying, the U.S. economy is running at a great clip and doing well. As I said, if we start to pull back, that can be a little bit more concerning. But I do want to touch on one positive note, though, as it relates to consumer sentiment when it bottoms out and when it falls significantly. You can see this on the chart to the bottom right as well. Usually, historically, when consumer sentiment bottoms out, and this has happened 9 times since 1971, the subsequent 12-month returns of the S&P 500 are 24.1% on average. So usually when consumer sentiment bottoms out, that's a good thing for the stock market, because that usually means there's a better path ahead. So there is some optimism there. I know we're talking a lot about some negative stuff here, but when it comes to financial markets, historically, once consumer sentiment bottoms out, there usually is a sharp rebound and a sharp rebound in financial markets as well. I'll stop there before we move on, but anything you want to add to that, Jarrod? I know that was a lot covered.
Yeah, it's, we're all forward-thinking creatures to one degree or another. And so you can clearly see that periods of high inflation tend to really dent consumer expectations. So if we're having changes in trade policy, which may drive some inflation in the near term, that's really concerning for consumers, because it's hard for paychecks to keep up with inflation that really spikes all at once. You feel it when you go, I know the discussion's been like the price of eggs for months, which is more tied to, we had a big avian flu outbreak in 2024 and had to cull a lot of chickens and turkeys and things like that. But, when you see that your money isn't going as far, that seems to dent consumers pretty quickly and pretty profoundly. So that's where we are. But I love your point, Tim, that That's the Warren Buffett expression, right? You want to be greedy when others are fearful and fearful when others are greedy.
Yeah.
Well, I think we're in one of those periods where people generally are feeling more fearful and more pessimistic, which it may not be a direct relationship that means we're going to have a great market period coming up. But usually it does follow that after periods like this, we actually have pretty good performance from equities.
Yeah, I think you make a good point about inflation as well, Jarrod. I think that was a big lesson for me from 2022 is how impactful inflation can be on the consumer mindset. When consumer sentiment bottomed below what we saw during the great financial crisis, that was eye-opening for me because in my mind, the great financial crisis was uh, terrifying, a terrifying period. And we all felt that, we still feel that viscerally. And to see sentiment fall below that period during that period was definitely eye opening. So I think we're seeing a rebound of that kind of mindset to an extent right now where consumers are saying, all right, inflation isn't quite as high as it was in 2022, but we could be headed back in that direction. That scares me. I don't feel good. So
Mhm.
I think that's a lot of what that chart is telling us.
So, kind of looking at volatility, uncertainty and negative expectations tend to create more volatility. Can you just walk us through on what's happened so far this year in terms of financial markets and returns and how that really relates to historical periods of volatility?
Yeah, I think it's been interesting to see volatility strike. And I think now is a good time to kind of level set, just to show everybody where we are at this point in the year, which have held up better, which assets have had the most volatility. So let me just run through the numbers really quickly here. So we see the S&P 500 down almost 5% on a year-to-date basis. So this is as of January 1st. Then we have the Dow Jones hanging in there a little bit more at down 1.7%. The NASDAQ down 10.6%. And the Russell 2000, those are small cap companies, by and large, down 9.4%. And then we look at some asset classes that have held up fairly well, and that's actually bonds. We look at bond markets. So the Bloomberg US Aggregate Bond Index up nearly 3%, and US Treasuries up 3%. So really what we've seen, and this plays out in the numbers, you look at our more growth-oriented stocks. When you talk growth, think more around along the lines of the Nasdaq and the Russell 2000. So from small cap companies, you want significant growth, and from the Nasdaq, that's made up of names. You'll think of the large tech companies as being comprised a lot of what you can see in the Nasdaq. Of more aggressive companies that have aggressive quarter-over-quarter, year-over-year growth. And that's representative of the NASDAQ. Those have sold off more precipitously. The Magnificent Seven, in fact, has sold off considerably on a year-to-date basis, and that's been dragging down markets to an extent. So, but it's important to note that volatility, I hate saying this because I don't mean to sound pedantic, but volatility is normal. We haven't seen volatility to an extent like this over the last 2 years, right? Markets have kind of moved steadily higher. Volatility as measured by the volatility index has been somewhat muted. We've talked about that in previous webinars. And we had said volatility is around the corner. We don't know when it's going to strike, but it will. Because if you look at the S&P 500 over the last 45 years, it averages an intra-year decline. So at some point during the calendar year, it averages a decline of 14.2%. That's a significant downturn. Yet, if you look at 34 of those 45 years, calendar year returns have turned positive. So despite some of these drawbacks, even in this case, this year, we're far from guaranteeing it, but we could see a rebound and stocks could end up higher by the end of this year from a year-to-date basis on a calendar year return basis. So, and we'll get into this on the next slides, but, when volatility strikes, it's really hard to stand pat. It can be very, very tempting to do anything to kind of reverse your fortunes, right? And often that can be where some poor decision making plays in, and we'll get into a little bit of that on the next slides. But I just wanted to cover returns briefly to level set there. Jarrod, anything else you wanted to touch on as it relates to the markets and what we've seen year to date?
It hasn't felt fun to go through the last 3 months, but these are really pretty muted returns when we do look at historical patterns, meaning that
Yeah.
this is a kind of typical quarter that we might see, and we're likely to see again. So 10% swings in the Nasdaq up or down on a quarterly basis are very, very normal. So nothing out of the ordinary, but we are all reacting to a bit more uncertainty and a little bit of a gloomier outlook in a couple of areas. So when we think about that, you just touched on it a minute ago, but it can feel like, boy, we got to do something, right? Like conditions have changed a little bit. We need to be making adjustments. Can you talk us through sort of that angst and then what we've seen historically in terms of adjusting rapidly to rapid change?
Yeah, yeah. When we see periods of volatility, we often get uh, investors really tempted to do two things. They want to time the market, which is potentially go to cash, and they also are tempted to chase returns in asset classes that are holding up better when volatility suddenly strikes. So we want to talk about timing the market to begin with. So um, if you go to cash, that's fraud, and we've banged that drum for a long time here at Destiny Capital. We talk about the importance of staying invested regardless of what's happening in the market cycle. But it's important because if you wanted to go to cash, for example, even for an extended period of time, and your plan was to like ride out all market volatility on the sidelines from here on out, you said, I've had enough, I can't take it, I'm just going to put my money in cash, and sit there and spend as I need it. I think if inflation from 2022 has taught us anything, it's how impactful inflation can be on the purchasing power of the dollar and how harmful it can be over time, and that can really snowball when you're in cash. And the chart to the top right helps to speak to this, where the green line is essentially the S&P 500 over the past 10 years, so returns in the S&P 500, coupled with essentially the purchasing power of the consumer dollar over that period of time. So essentially, if you're sitting in cash, you're losing money over time, and that's just obviously not going to work out over the long term as you're trying to keep up with rising prices on everything that you're essentially purchasing. And if we see another spike in inflation in the months to come or years to come, or 10 years from now, that can be even more damaging if you're on the sidelines. More often than not, though, we don't see investors tempted to go on the sidelines for the long term. We see investors wanting to sit on the sidelines for a period of time to weather this storm. So I wanted to provide a quick example from the recent past as to how that had played out for certain investors who during the pandemic, the onset of the pandemic, decided to make some changes. So I think this is all really, still in our minds. This wasn't that long ago. But the chart to the bottom right helps to speak to this dynamic where if you look at the chart to the bottom right, what we're showing here is the blue line shows the path of the S&P 500 again, and the red line is showing U.S. mutual fund and ETF fund flows. So when you see that red line descend very, very, very rapidly there in around March of 2020, that means investors are selling out of mutual funds and ETFs and going to cash. So we saw that. I mean, remember back around mid-February, we saw a steep sell-off begin in the stock market that really bottomed out. We saw about a 30% sell-off between mid-February and mid-March of 2020. It was a very scary time. I think we all recall that very, very vividly, where we weren't quite sure what the path of the global economy was going to be. Everybody was working from home. We were talking about 2 years until we might have some kind of vaccine that could help with something along the lines of the pandemic. So that was a scary time. So I think a lot of investors said, okay, I'm going to sell in March. I'm going to ride this out, see how things play out, and I'll get back in at some point. Well, the stock market had something else in mind. And if you can see this in the blue line. So right as people sold off into cash, we see the stock market rebound. By October of 2020, the S&P 500 had recovered all losses, and by year end ended up the calendar year up 18%. So I'd wager that most of the people in that red line that sold in March of 2020 did not get immediately back into the market. They were saying, like I said, I'll wait this out. This is going to take a while, and I think I've got some time to figure this out, and then I'll get back in. Well, we've covered this on previous webinars. If you miss some or all of an upswing, a rally in the markets after a period of volatility, that can be hugely detrimental to long-term returns. Just missing 1, 2, 3, 4, 5 days can drastically impact long-term returns. So just remaining invested, if you can remain invested even throughout 2020, you should be able to navigate just about any volatility. But I think that was just another important lesson, another lesson from the recent past that we could use to speak towards how tempting it can be to time the markets and how that can really backfire on you quickly if and when markets rebound. Jarrod, anything else you wanted to add to that? I know I went quickly.
Yeah, this webinar is really intended to speak from an investing perspective, but this is also part of why we do financial planning with all of our client families and investment specific planning. So if you are one of our client families and you're feeling concerned right now, go ahead and grab time with your advisory team, and we'll walk you through, here's cash reserves, here's, assets that are not going to be as volatile, that will still be liquid. Let's look at what your spending needs are in the next 1 to 3 years and make sure that we have those accounted for, because I think that's another component here that gives us the ability to have more endurance as investors, is if we know that, hey, I'm going to have assets which are going to be more volatile for periods of time, and that's part of the nature of investing. But we also want to mix where we have cash and other low volatility investments that you can access so that you don't have to sell those higher volatility assets when you don't want to, which is during times of greater volatility. So just one thing from a planning perspective, make sure you talk to our team. If you don't work with us already, reach out to us. We can help walk you through kind of the philosophical approach to how to design cash reserves and low volatility reserves as well.
Yeah, that lends itself to portfolio construction, right? So if an investor is feeling angst about what they're seeing in their portfolio over time, then I'm not really doing my job. We're not doing our job as an investment committee, matching the portfolio with the investor's risk tolerance and what they're willing to absorb over time. So that leads to a discussion between the strategist and the client and the investment committee to say, okay, what tweaks can we make to make you more comfortable so you can sleep at night when you see volatility strike and the markets start to go up and down on a day-to-day basis, like we've seen over the last few weeks. So yeah, really important points there, Jarrod.
So as we move into kind of the end of our discussion today, do you want to talk about return chasing, which can be another dynamic that we see because volatility tends to give more dispersion in returns. You'll have things that do really well and things that do very poorly as the market goes more volatile.
Yep. And those things are really, really difficult to predict, right? So, what's going to do well and what's going to do poorly during a period of inflation or a period like where there's trade uncertainty. I mean, there is global trade uncertainty. So it's difficult to imagine that something can drastically outperform the other when so much uncertainty remains. But it's easy to look at other asset classes, or like Jarrod, we've talked about this, you talk to your golf buddy or somebody, a friend who has an asset that's performing great over a period of time. And you're saying, well, why don't I own that? An example of what this might look like today would be global stocks. So this includes emerging market and developed market stocks, basically the world except for the United States. These stocks have held up better on a year-to-date basis. So you can see this on the chart to the top right, where we show the MSCI ACWI ex-US, so the all-country world index without the United States. That's the blue line. And on a year-to-date basis, essentially global stocks are up 7%, whereas you look at domestic stocks as represented by the S&P 500, down 5%. So, it can be easy to say, well, why don't I own that? Why didn't I own that for this period, or have a larger allocation, right? Why don't I own 30% of that instead of 5% or 2%? You could start to second guess and question that. And I think it's important to know what you own and think over a longer term period of context. And to illustrate this, we look at the chart to the bottom right. So I honestly, Jarrod, I can't tell you how many analysts, portfolio managers, fund salesmen have told me over the last 15 years, international stocks are going to outperform U.S. stocks. It's happening. It's coming. It's virtually guaranteed. You look at the dispersion in valuations. I mean, 1,000 reasons. Look at the chart to the bottom right. Over the last 15 years, the U.S. stocks, the S&P 500, has had a return of, let's call it 570%, versus the rest of the world, which has over that 15-year period a return of 115%. So 115% is nice, but it's not 570%. So if you owned significant international, if you had a significant international allocation at the time all of this volatility struck at the beginning of 2025, there's a chance you've owned it for a long period of time. If you've owned it for a long period of time, it's been detrimental to returns relative to domestic stocks. So it's all perspective, right? It's just mindset, understanding what you own, why you own it, not getting as your dad, Jarrod, Steve would say, don't go chasing squirrels. Don't get excited about another shiny object and lose the discipline of your portfolio and why you're invested in the way you are. And that's really important at times like these, just to know what you own, why you own it, maintain investment discipline around going to cash, maintain investment discipline around chasing returns, and more often than not, you end up at a better place when it's all said and done. So anything else you'd like to add on that one?
No, I think as we wrap up in our conversation today, knowing what you own and knowing why you own it, if you don't feel like you have a good understanding of that, reach out to your team here. We're happy to have an investment meeting and go through portfolio design and dynamics and expectations and all of those things. So I hope our conversation today was helpful, just thinking through what can feel like a stressful and kind of unsettled time period, and why you have the approach that you do. There is a design, there is purpose behind all of this. So if you don't feel comfortable in that, reach out to us, reach out to your team. We're happy to walk through all of that with you and make sure that you're in a place where you feel like you have a good understanding. And if needed, we can always make changes, right? This is your family, your future, your money, all of those things. We're here to help get families where they want to get to. So let us know how we can help with that. Tim, is there any closing thought that you'd like to leave the audience with?
Yeah, it's not to say that we're averse to change, right? We do monitor and change portfolios over time. What I'm saying is there's just so much uncertainty right now. It's hard to make high conviction decisions around investment allocations, where you want to go versus why is one asset class better than another at this point in time? Because we don't know until we get more from the Trump administration around tariff and trade to get more guidance on what that might mean for the future in order to make those types of investment decisions. Once we get that information, we should be able to look at that pretty quickly and gauge if that's going to be impactful to long-term investor returns. But yeah, I wanted to point that out. We've got our eye on the ball. We're watching very closely what's going on with tariffs and trade, and we will provide you with updates as they emerge. And if necessary, we will absolutely update and make changes to client portfolios if we deem that's necessary. So I just wanted to close on that final point.
Yeah, absolutely. Well, thanks to each and every one of you for giving us some of your very valuable time. We will always endeavor to make sure that it's time well spent. So if you have suggestions or requests for future webinars or content pieces, feel free to send those over. We always love those suggestions so that we're talking about things that are of interest to you and your family. So we appreciate all of you. Thanks so much, and we'll be back again soon.